Welcome to another episode of the Kinvestor Report, where I chat with industry experts to discuss the market, commodity, stocks, and the economy. I'm your host, Arlen Hansen. Today, we're thrilled to welcome a special guest to the show, Don Durrett. He's an accomplished author and a 30-plus year gold investor. He owns goldstockdata.com, where he empowers investors with valuable insights into gold and silver stocks through data and analytics and some common sense. This interview is not investment advice. I repeat, not investment advice. I'm not an investment advisor or financial planner. If Kin Communications or myself has any financial interest in any stocks mentioned in today's interview, it will certainly be disclosed. Please do your own due diligence. If you like this video, you can tap that like and share button and be sure to subscribe to our channel so you don't miss any of our latest content. Don, thanks for joining me today. How are you doing?
Hey, Arlen. It's good to be on. First time.
Yeah, well, you're drinking the invisible coffee. It looks rad. It's not showing up on the screen. Yeah, so welcome to our show. We're going to dive a little bit into stocks, gold stocks, silver stocks. I think that's what our audience wants to talk about. But first, give us a little bit of background on goldstockdata.com. You got a ton of analysis. You look at a ton of companies and educate your subscribers. So tell me what that's about.
So, 2004, I started investing in juniors, and I couldn't find any data out there on how to do this. I mean, okay, I want to find leads, right?
Mhm.
So it was pulling teeth. I mean, trying to find stuff. So after, and then I couldn't find any books on the topics. So after 6 years, I had to learn it all on my own. I remember when I first started out, there was these two guys that used to do a podcast. I sent them in and sitting questions. I said, "Okay, is there any books on how to invest in junior miners?" And Bob Chapman, it was his show. He's no longer with us. Bob Chapman says, "There isn't any. Sorry." Guys, this Bob Chapman been around for a long time, and he
Yeah,
told me
yes.
flat out there is no books on how to invest in junior mining stocks. So I had to learn on my own. So I wrote the book. After I wrote the book, I decided I'm a programmer, so I started programming a website.
Okay.
And 20 that was in 2010. And some guy saw my website and basically said, "You got data, but the website's a piece of junk." So he goes, "I got a shell. I got a shell. So let me show you the shell." So my website, Ghost Identity, was kind of the shell he showed me. My purpose behind the book and the website has always been to help people, to give them information. It's not a stock picking stock. Not I'm not picking stocks for you. I'm helping you. I want you to do your own analysis. I'm giving you some data. I'm giving you some leads. I want you to do your own due diligence. That's why it's called data. Stocks like data, not gold stock picks. Everybody wants picks, picks, picks. Pick my stocks for me, Don. Picking your top 25. I give you my top 25. I give you my favorites, but I want you to go down the list and find out which ones of those do you like. Don't just like all of them. I mean, figure it out on your own kind of thing. This is a really risky business. Know what you're buying. So
I
that's a
think,
little view of me.
yeah, if I could interrupt there too as well, I think the important thing about that is you have to like it. And that also means part of your due diligence is probably talking to management, or it should be, and getting the DNA of the company. And you may like management, but you may not have a good connection. Like the investor may not have a good connection or feel good about that person. And that's not a good thing to invest in, because you don't want to be holding on to that fear at night of like, oh, is this a really good investment? Right. So I like what you said there. Like, you're just showing people what you like. Go do more due diligence, do more homework, find out what you like to do. Um, I think you have 800 companies under analysis.
850, 850.
800, 850. So what's your criteria behind these?
Yeah, to get in my database, you need to have a market cap now today, because once I got over 800, I was basically adding everything until I got to about 800, 900. One time I was over 900. And then, I think it was over 900 when I changed my criteria. So my criteria to get into my database is a $10 million market cap US, and then you have to trade either in North America, Australia, or London. So those four. So if you only trade in China, Hong Kong, or Germany, or France, then I don't do those. There's only like one company that I don't have in my database that doesn't trade in London. There's a silver miner in Poland, It's not in my database because they don't trade in London or New York. It's kind of crazy. But other than that one company, I'm pretty much got everybody. I mean, I'm not really missing anybody. So if you have a
Hmm.
market cap of 10, you're in. Let's
Okay.
put it that way. But I only add 5 new companies a month. It's all I can basically handle. My webmaster he's kind of slowed me down. A little bit of work to add a new company. So I told him, okay, we'll just do 5 a month. So I
Okay.
only add 5 new ones a month. So if you tell me, okay, Don, add this stock, it might take a couple months to get in the database. Well, I wanted to say one other thing. You mentioned about doing your due diligence and talking to management. That's really just the tip of the iceberg. Everybody has their own strategy, and your strategy really dictates what you're going to like and what you're not going to like. And the other thing is, people don't know, sometimes people don't even know what their strategy is until they actually start. And your strategy really is impacted by how much risk you can take on. So people will buy these stocks and they won't realize that it's literally too much risk for me. And then the volatility will kick in and they'll be dead, and they won't even realize how much risk they took on. They don't know. So you got to learn how much risk you can handle. You have to know, is your philosophy to make money in 12 months, 24 months, 36 months? So you got to make all these decisions. And so everybody's different. So how you approach a stock, everybody approaches a stock differently. So I might approach it one way. I approach it long term and I approach it in a variety of ways. But the way I approach a stock is not how you're going to approach a stock. So
Hmm. Hmm. So how do you know when you've bought into something there and then you go, oh my God, I don't know if I can handle this volatility. Like what are the signs? Lack of sleep, like making
yeah,
erratic trades, trying to
yeah,
sell
I love
trying to
that
sell at the
question.
bottom, right?
Yeah, I love that question. So when I first started out doing this, the first thing that I learned was exactly what you said. Can I sleep? Right? So I found that it's like, how much risk can you take on? What's your comfort level, right? And I found that I learned what my comfort level was, and that was, I don't want to have a drill story that doesn't, and I had to learn this over time. I didn't learn this overnight, right?
Oh, we learned.
I don't want to have a drill story that doesn't have a discovery, and it doesn't have a discovery hole. All they're doing is poking holes all over the place. I don't want to be overweight that stock. It's stupid.
Hmm.
Because if I'm overweight that stock, I'm way over my skis on risk. So I found that so that was a kind of a starting point for me. I realized that I call them lottery picks. These lottery picks, I don't want to have a whole bunch of these lottery picks. That just doesn't fit me at all. No, no, no.
Hmm.
So then I found that what makes me really comfortable is a really high quality producer that has upside. Like, that we just saw a deal with Equinox and Calibre. So
Yeah.
both of those companies are producers. Equinox has a little bit too much risk for me, but the risk should decrease over time. But it's like for me, I'm pricing stocks now at $4,000 gold. So it prints out like 7, 8, 9 bagger, and it's a 600,000 ounce producer. And those are the kind of companies that I want to own, but I want them to be more solid. So Calibre is smaller. They're only producing, I think, 300,000 ounces, and they're growing. And they have a little bit of risk in Nicaragua. They're not quite solid as a rock yet, but these are the kind of companies I own. But I have recognized that neither of those companies are solid as a rock. They're not ideal. So I'm always trying to find kind of ideal stocks that kind of reduce your overall risk in your portfolio, but they give you a lot of confidence that your portfolio is solid. So when those two companies merged, I was ecstatic. I'm going, this is awesome, because what it did was it was two birds with one stone kind of thing. So when I merged those two together, my upside didn't go down very much because Calibre was like an 8 bagger, 9 bag. They're both basically 7, 8, 9 baggers. I mean, they're both huge upside. So when I merged them together, it came out as a 7 bagger, and it was a merger of equals. But so I only went down a little bit in upside, but what I gained was comfort, much stronger,
Diversification. Yeah.
much stronger. Well, this company is going to be the second largest Canadian producer. I love Canadian producers, and and now they become a shark where they can basically, so they have stability now. They have stability because Equinox is kind of all over the charts, really high cost, high debt. They were kind of out of control a little bit. So now I got a company that's solid. If this deal closes, and I don't know if it will, because if I was a large company, I would go after Calibre right now, because Calibre was just too cheap.
Mm-hmm.
Merger of equals didn't really make a lot of sense. A lot of Calibre investors are upset right now because it didn't make a whole lot of sense for Calibre in the near term. But in the long term, it makes perfect sense. So if you're going to hold this stock for 3 years,
Mm-hmm.
you're going to get that 3 year, you're going to get about the same return. But after 3 years, you're going to be sitting on an Agnico, type of company, a real, really big, major, really strong. So they're going about, I think they're both about 2 billion, 3 billion. They go to about 5 billion. They're going to go to 15. They're going to go 5-15 fairly quickly. They're going to be a big company very quickly, but they still have a ton of upside. So my point is this, is that I want to have as many of these companies that are kind of dependable, that I'm really confident in, that they're going to work, and they don't have this huge risk, which is the norm in mining. The norm in mining is a lot of risk. So when I can get my hands on a company that is going to be kind of a really solid performer, I want as many of those I can get my hands on. So this is the type of deal I like, but it just shows you there's different in every category. So you got exploration, you got developers, you got producers. In every single category, each one of those you have peers, and each one of them has different levels of risk. So that's what my book's about. My book explains the levels of risk in each of these categories. And in each category, you want to own the best ones, the best risk reward, but you want to make sure they have upside. And it's hard as hell to learn how to do this. I haven't done it for 20 years, but you can do it maybe in 2 years to have a bit of an understanding, but it really takes about 3 or 4 before you're kind of comfortable you understand what you're after and what you're not after. But I want my portfolio to be overweight producers, and then my developers and explorers, I don't want those to have way too much risk, that even though I'm overweight producers, I still have too much risk in my portfolio. I'm always trying to have a risk level that I'm comfortable in. And I am today. Today, it's taken me years and years to build my portfolio. I have 160 positions. But today I'm super excited because the price of gold, we can talk a little bit about that, is really trending up. And I basically have bought all of these producers and high quality developers over the years, waiting for this situation. It's basically I'm just build for my portfolio. I'm not a trader. Build, and then wait for this outcome that I've been expecting. And that outcome is the U.S. Financial system basically forced to reset itself because they can't live off of debt. I've always said MMT is fantasy economics. It won't work. It's just a matter of time before there's some type of a reset. And I think that reset, now everybody's starting to see it. And I always thought the reset was inevitable, and that reset just pushes gold to the moon. And that's what I'm doing this for. I'm not doing this because I like gold and silver mining stocks. My ownership of gold and silver mining stocks has nothing to do with I like gold mining. It has nothing to do with that. It's because I look at the U.S. financial system, and I see a financial system that's built on sand. And then I look and I say, okay, if that, and House of Cards, if it falls, who benefits? Well, gold benefits. So if gold benefits, okay, gold's going to benefit. Well, okay, if gold benefits, then who benefits from gold? Well, gold miners do. So that's the only reason I own gold miners. Not because I like the business, not because I like the industry. It's because that's who benefits.
Yeah. You talked about loving Canadian producers. So why?
Location risk. So Australia and Canada, their main industries is mining. It's their main industry. In the U.S., our main industry is high tech, and maybe healthcare, maybe farming. Those are kind of our big three. But Australia and Canada, mining is their number one industries. I mean, that's what those countries do. They mine.
Mhm.
And even though they're blue states, they're liberal, they're socialist, their politics is trending in the wrong direction. They can't give up on their number one industry. They can be as socialist as they want to be, but they still have to support these industries.
Tell that to Justin
They
Trudeau,
can't
please.
rug pull these industries. But over in Australia, they recently rug pulled two companies' permits for political reasons. So
Interesting.
you're still seeing the liberalism kind of sneak in the door. Um, the first one, Silver Mines. I mean, they basically are finding really nitpicky reasons why to not give them their permits. I mean, for Silver Mines, it was a power line. I mean, it was just a joke. It was total politics. Somebody
Hmm.
that didn't like mining said, "Oh, that power line's out of you can't create your heap leach pad there, your tailings project there." There was that one, and then Regis Resources they had one. It was another nitpicky one. So we're starting to see, and in Canada, we're seeing a little bit of it as well, where you're seeing some of this nitpicking on permitting, which we
Oh
never
yeah.
had in the past. So we're seeing that, but that's on the margin. But on the whole, these are probably the safest place to own mining companies, in my opinion. I love Australia. Nobody's buying these Australian miners.
Hmm.
Everybody's going to be running to them when after we get the mania. The mania comes in, and then after we get the mania to come in, what's going to happen is in Africa and in South America and in Central America, is these emerging markets, they're going to raise their taxes. And once they raise their taxes, people are going to go, where do I invest? Where do I invest? Well, Canada and Australia and the US. So
Hmm.
people are going to move their money out of those emerging markets and into Canada and Australia, and their multiples are going to explode. Nobody sees this coming, but for me, it's clear as day.
Yeah. Do you think the years and years of bureaucracy and red tape is kind of coming to an end when it comes to these mining projects? Like I know that I'm talking to some companies down the States are like, yeah, we're getting our drilling permits pretty quick now. Like things are changing to that level, but do you think we see a shift? Do you think that will change again, the psychology about it all? Like people just
No,
hate mining, hey?
no, it's like turning a big ship around. It just takes a long time.
Hmm.
The only thing that's Australia, you're not going to get in Australia and Canada, those two countries, you have their the political system is not going to improve, if you will, on mining. It's going to get worse at best in those countries. They're not going to suddenly start permitting these projects. The best we can hope for, it doesn't get worse faster.
Hmm.
And so permitting is not going to improve in Australia and Canada. I mean, at best, it's going to stay where it's at, and it won't get worse. In the U.S., you got Trump came in, and people are all excited that Trump's going to help the mining industry. Well, we're going to find out this year if that's true, because the Pebble project in Alaska, right now, there's a lawsuit. The state of Alaska is suing the federal government, suing the EPA, and they basically did a 90-day kind of hold on all that stuff. The lawsuit's on hold for 90 days. So we're finding out after 90 days exactly what the verbiage is. I think they're going to drop the lawsuits, and then Pebble will get green lighted. But just because Pebble gets green lighted doesn't mean that they're going to start handing out permits to Pebble overnight. They're going to still have to start going through hoops
The
before they
process,
get
yeah.
all of their permits. Those permitting is not going to turn on a dime. You still have we've had years and years of a trend towards focusing more on environmental, stewardship, and that, looking at making sure that the water's not harmed at all, making sure the animals, the nature not harmed. and it's very meticulous. And that's they have to have these baselines, and it takes years and years to do the baselines. That stuff's not going away. All that baseline stuff, all the permitting process is it's meticulous. It takes long times. They're not just going to turn that off. The best case scenario we really have here is they're going to expedite some minerals, such as antimony. They're basically going to say, in tungsten, we don't have any of that stuff here. We need it. Let's speed these permits up for that. Critical minerals, they might speed up, but they're not going to call gold and silver critical minerals.
No, they never will, ever.
No,
over their dead body.
those permits are not going to get sped up. So I'm not bullish on permitting. Also, Hecla's been trying to permit 2 projects in Montana for 10 years.
Yeah,
they bought these projects 10 years ago. They're advanced projects. They don't even talk about them in their presentation.
Yeah. There's some incredible geology down there.
How slow the permitting is. We don't even want to talk about these. I think Hecla finally actually brought up, the last few years they've ignored them, but I think they finally actually brought up this one of their projects in Montana, but they still can't see the end line. The one thing that's bad about permitting in the U.S. is they go into a black hole. It's like, we're gonna start the process, and then but they never have a timeline. Okay, we're gonna get this. They don't know, because it's a very circular permitting system. What I mean by circular is you go into this one agency and it has to go through like 10 different approvers. It's like this circle. You gotta go through that circle before you actually get out of that building, and it takes forever. So, I mean, I don't think that Hecla will permit those 2 silver projects for another 5 years. It's crazy. Yeah, it's difficult. But that actually benefits us as gold and silver investors, because when the price of silver goes to $50, they can't just start building silver mines.
Yeah, you're not going to see like a massive supply overnight, right? Like,
not happening.
Yeah. I'm going to go back a little bit. You talked about levels of risk in investing in the different stages. So exploration, development, production. So I understand the risk involved in exploration. It's like 1 in 1,000. Okay. But is it riskier than the development stage or the production stage? Because I've seen also projects that, 2 engineering studies, $500 million raised, they turn the taps on and the thing doesn't work, right? I think it was European Minerals back in the days in Kazakhstan had this incredible asset, right? Like I've seen that time and time and time again. Nevsun Resources went into production. They were a client of mine for a long time. They had to restate their mineral reserves, right? And so the big risk there, stock gets crushed. So there's risk in all these stages. And we talk about when we get in production, now we're talking about permitting risk, environmental risk, currency risk, forex exchange, like all these things. So is it even that much less risky than the exploration stage to some like?
Yes, huge difference. Okay. And what you have to do, and again, it takes some time, is I've learned, and I have a video on my website, on my YouTube video. It's in October. So if you go and look for October 24, it explains how you identify risk. It's only 20 minutes long on exploration, development, and production. And I explained the little check boxes you use. So for developers, what people miss is they don't look at the check boxes. But if you can find a developer that checks all the boxes, yes, your risk is much lower than an exploration play that doesn't have a discovery. Now, if you have a company, an exploration play that has a discovery, and that discovery, the gold in the ground or the silver in the ground, is being valued way below the current market rate. For instance, it costs about $50 to find an ounce of gold in the ground. If you can find gold in the ground for 10 or 15 bucks from a company, and it's like 2 million ounces or more, and it's growing in size, your risk is lower than owning an early stage developer. Mm-hmm. So some exploration plays are less risky. That's a company that already has a deposit. It's growing in size. It's in a good location. So
and tons of cash. Tons of cash.
Yeah. No, you don't. No, you don't. They can just sit on it. They don't need tons of cash. They don't need any cash. They can just sit on it, $250,000 a year to hold it.
Hmm.
So no, they don't. It's nice to have tons of cash if they're going to drill like crazy.
Yeah, yeah.
Absolutely. It depends on how aggressive their exploration projects are. But each stage has different levels of risk. But on the whole, you got to be really careful on exploration plays that don't have discoveries, because, like you said, it's 1 in 1,000. It's like when you go and drill and a greenstone, a brand new area that doesn't have a discovery, one drill hole out of 1,000 is going to find a mine.
Crazy. Yeah.
It's a lottery pick, and so it's really hard to find large economic mines. Really difficult.
Yeah.
And people bet on it all the time. It's like playing roulette. The odds of winning is against you. I always say you want to wait until there's a discovery hole. And in my video, I explain what a discovery hole is, a good discovery hole. So you have a good discovery hole, then those are the kind of stocks that you can bet on and you can make money, because they have a discovery hole, it's cheap, you're getting in early. That's how you make money on exploration. You either get in early on exploration plays, or you bet on these optionality plays. Like Banyan Gold has, 10 million ounces of gold heading to 12.15, and they're trading like $6 an ounce in the ground. It's almost impossible to lose money on that situation. Free Gold Ventures is similar, $10 in the ground. If you can find a real solid project that's trading at 6, 10, $12 an ounce in the ground, it's hard to lose money. All you're doing is sitting around and waiting for that gold to get repriced higher. But development projects, it's all about the check boxes. You got to make sure they check all the boxes. And there's a lot of people all the time are always sending me, on Twitter. They're basically trying to tell me that this is a great development story, but they don't understand the check boxes. And for me, one of the biggest check boxes is, you mentioned earlier, management team, but it's a combination of my confidence level in the management team in tandem with their plan. If the company has a plan of how they're going to take that development project to production, and they have insiders, the risk goes way down, because they don't have to sell, because they have the insiders and they have the plan. All they have to do is execute. The risk goes way down. But most of these companies don't have plans. And for me, that is just a red flag. Like, I won't touch these things. I'm like, no, I'm not touching that thing. And I'll wait and I'll watch and I'll wait. And then if they show me the plan, then okay, it checks the box. Then maybe I'll jump in. But I love development stories that check all the boxes.
Yeah. Speaking of plans, I had a client about 6 months ago send me their 1 year business model. I was floored, because you just don't see that like in early state. Like, I was like, wow, these guys know, they think about this. They've got a plan. They're executing. And my confidence level went, it was like, whoa, I don't see this before, like very much in exploration. Right. So that was really cool. I had other questions. I keep on writing notes. That's why I look down over here. Oh yeah, we were talking about exploration. So any names out there that stick out with new discovery stories out there?
You know, I'm overweight exploration. I have too much, so I'm not really jumping on early drill stories. There's definitely been some lately. I can't think off the name, but my mining notes that I post, I collect mining notes on a daily basis. And somebody recently there's been a couple of monster holes lately. I've seen a lot this year. I've seen quite a few these early monster holes that historically I probably would have jumped on, but they're not in my head right now because I didn't buy them. Because I'm not interested right now in adding to exploration, to add to these early exploration, but they pop up all the time. You have these companies that have market caps under 20 million that have a discovery hole. And those are the ones that you kind of want to jump on, and I haven't. I remember there was one that recently, I might be able to look at my notes. It was 2 meters at 300 grams. That's potentially a huge gold. That's a pretty big one. There's been a few out there, and that was an early exploration discovery. But most of these are kind of advanced exploration that have been putting out these really good holes lately. And those are the ones you don't want to chase. Like once they get above 100, 150 million, you don't really want to chase those. So lately, there's been some companies putting out some really good holes, but they're late. They're kind of advanced exploration. So for me, the only exploration stories that I'm really excited about right now is the optionality. And I mentioned that earlier, buying gold in the ground at 6, 10, 12, 15, especially companies that have that are priced at that level and they're still in their deposit is still growing in size. That is even better. So I mentioned Banyan, Free Gold Ventures, another one, Southern Silver is trading at 25 cents in the ground. Those are kind of three optionality plays that I've been, that I like a lot, that I think should pay off. But there's a lot of them. I bought Lahontan 2 million ounces in Nevada. They were trading at, I think, less than $3 an ounce in the ground. I think I paid $2.50 in the ground. They got down, their valuation was like 4 million, and they had 2 million ounces in the ground, 5 million. They're just giving it away. Another one was Getchell. Getchell's another one in Nevada. So you have a lot of these optionality plays where you have these companies that are just trading at pennies on the dollar for what they have in the ground. All I have to do is just sit and wait for this stuff to get revalued higher, the rising boat thing, the rising tide. So eventually gold in the ground is going to be, the minimum is going to be 25, and right now it's like 12.
It's crazy.
It's 12 right now. The average value of gold in the ground right now is like 12 last I looked. So it's going to double to 25. So all these companies are going to double in value. And then some of them will double again to 50 and then double again to 100. And then they have your five bagger.
When you talk about optionality, so company A has project B, whatever. And when you want optionality for exploration upside, are you looking for adding more reserves to project B? Or are you looking for other projects that can be like, oh, brand new discovery?
Yeah, so this is where it takes years to learn this stuff. No, for exploration plays, we could care less about reserves.
Okay.
We don't care. We don't want them. We do not want them to spend money. In order to have reserves, all it is spending money on scoping studies, drill holes to make it economic. That's not what you want. You want to show that the gold is there. That's all you want to do. Inferred can be good enough because the geology, how the spacing on the drill holes, the companies that are going to buy your company, they know what's there. So you don't need reserves for exploration. It's in many respects a waste of money, waste of time. A lot of these companies, they don't even do PEs. They don't even do maidens. Newfound Gold, they've been drilling for 5 years. They haven't even done a maiden yet.
Yeah. Like, whoever's buying you out has got the data room and the technical team to come up with their own reserve estimate or their own.
They know it.
Absolutely.
But but I do like it to turn it into M&I. So if it's like half of it's M&I and then half of it's inferred, I like that. I like about 50-50. That tells me that they've done enough drilling to show that it's there. But then the geology and the drill holes will tell the buyer if that inferred, how much of that inferred is going to turn into. But all you're doing is, what you want to do as an exploration play is you want to add ounces. Because when you go to sell that company, you're basically going to say, look, I got 3 million ounces. I want $100 an ounce. That's 300 million. Write me a check. And then if they say, well, we're only going to pay 150 million, say, sorry, that's not the number. Call me back. Hang up. I mean, that's how it works. I'll give you a perfect example. It's Free Gold Ventures. They're trading at $10 an ounce in the ground. Eric Sprott owns 29%, and another group, the Prince George Group, owns about 25%. So between those two private shareholders, they're private shareholders have nothing to do with the company, and they own over 50%. The only way anybody can buy that company is to get one of those two groups to say yes. Other than that, if they get a phone call, Ken Ross is right next door to them. The Fort Knox mine, which is they just do a conveyor belt and convey that ore over to their mill. I mean, it's easy peasy. So, and Fort Knox only has about 5-year mine life left. So Ken Ross calls them up and says, hey, we want to buy your mine. And they're like, yeah, sure. How much? They're like, well, $50 an ounce, and oh, let me call Eric and see. Right? And
Yeah.
Eric goes 50. Yeah, call me back when you got a serious offer. I mean, that's exactly the situation. So all Freegold's doing right now is adding ounces.
Yeah.
So when they do call, Eric goes, okay, 30 million times 100 is 3 billion. Write me a check for 3 billion, you're good.
Take it or leave it. Take it or leave it. And he's got enough.
Wait.
Yeah.
And Kinross says, well, Kinross not going to pay $100 an ounce today. No way. It's at $10. They're not going to pay a 10x premium. So they're not going to pay a dime. So what's going to happen is no one's going to make an offer until gold gets to about 32, 3,300. And then there's three majors in Alaska, and a new one could come in, but a major is going to go in there and make an offer, north of $50, and then that'll become the new baseline.
Yeah.
So we don't have a baseline yet of an offer. Somebody will make an offer, we'll get a baseline, and word will slip out. And then once you have a baseline, it's just a matter of time before it gets sold. But first we need a baseline. But right now, nobody's getting any offers. We don't even have baselines. We don't even have rejection slips yet. But it'll happen once the M&A kicks in. Once the HUI gets north of 400, the HUI is about 320.
Yeah.
Once the HUI gets north of 400, the M&A will all start. It's already started. We've seen 5 deals this year.
Yeah.
More than 5. And so the M&A has already started. It's just going to pick up speed.
Yeah.
But after 400, you get above HUI 400. And the reason why the M&A picks up when you get above 400 is that the boards are paranoid that if they do a deal, their share price drops. That's what they're afraid of. They don't want to do a deal where their share drops, because then they can get sued. The shareholders sue them for a bad deal, and so they don't like that. They don't want their share price to go down if they do a deal. Well, when you get the HUI above 400 and their share price is trending, you do a deal, it's not going to crash. So you can do it.
Yeah. Timing.
Share price is trending. That's why M&A will kick in above 400 and everybody's doing good. But people don't like to do deals. That's the reason why Equinox and Calibre was at market. Because if they would have paid a premium for Calibre, their share price would have dropped.
Got crushed.
Right. And then the Calibre guys wouldn't approve it.
Yeah, so, I do like that merger. I think that those management teams are very synergistic. I think that deal made sense.
Absolutely. It made sense.
Yeah.
For the long term.
Yeah. So speaking of Eric Sprott, I still shake my head. I just can't believe how rich he is. Like I see his filings everywhere. It's crazy. He's owns like 150 million shares of this Discovery Silver that just acquired these assets from Newmont. Can you talk about that a little bit?
Yeah, Discovery Silver is my favorite silver development play.
Oh, okay.
And the reason why is because it's just massive. I mean, they got 1 billion ounces of silver. Nobody else has 1 billion ounces.
But that's in Mexico, right?
Yeah, it's in Mexico, and only 500 million ounces are part of their plan. They got another 500 million in the back burner. It's kind of insane. So it's a long life mine that, I mean, it's a company maker. It's a town maker. I mean, the people that are going to work there are going to work there for the entire career. We're talking about a 30-year mine life. It's in Chihuahua, which is a mining district. So it's going to happen. It's a beautiful thing. I mean, it's economic at $25 silver. It's going to happen, and it's going to be worth a fortune. And now they have the team in place. They have the insiders in place. Now they bought a large gold miner in Canada. They basically had that opportunity. It popped into the board just said, "Hey, we got this opportunity to buy this producer." They bought it from Newmont, and they basically said, "We can buy this gold producer in Canada. You guys want to do it?" And the board's like, they start working through the numbers, and they're like, "Yeah, this works. Let's do it." So now they're no longer, well, they'll be a producer, I think, second in I think Q2 of this year. I think that deal is going to close. They'll be a producer. So it's going to make them it's going to help them finance the project. But not only that, it's gonna make it easier for them to build this mine, because when you're a producer, you just acquire more skill sets. So they're going to be a producer up in Canada, and they're going to be able to transfer some of that knowledge down to Mexico. It's going to benefit them, and it's going to make them a stronger company. So So I love discovery. And remember I talked about insiders. Insiders are really important for development stories. And discovery checks all the boxes. They have the plan, they have the team, they have the upside, they have the insiders, they have everything.
That's a Tony McCooch deal, right?
Yeah, it is.
So he spent his whole career in this complex. So
yeah, he knows what.
This made a ton of sense.
Quality. Yeah, he was the CEO of Kirkland Lake, and one thing I have my fingers crossed on is that they replicate the Kirkland Lake model, and very few companies have replicated it. Really, it irritates me to no end, because Kirkland Lake was almost like the Donald Trump of mining. I mean, the majors they hate what Kirkland Lake did. So the Kirkland Lake, what their model was to put a whole bunch of cash on your balance sheet. They had like $750 million in cash and no debt. And the majors hate to do that. The majors, it's hard to find a major like a market cap of $4 billion with no debt on their balance sheet.
Of course not.
And
is there one? I don't even think there is one.
Kirkland Lake did it, and they had a multiple of 25, and investors loved it. They were just that's the model that I like. I want somebody that has at least 100 million in cash, but the more the better. So for a mid-tier, I want like 100 to 300 million in cash, and then for a major, I want 500 million or more in cash and no debt. And then if they need debt to build a mine, I want them to tell the market, look, we're going to borrow 700 million bucks to build this mine, but we're going to pay it back in 2 years. That's a cash focused business. And so I'm hoping McCooch does the same thing. He basically starts building cash, because now he's going to be building this cash from Canada, build this mine in Mexico, and say we're going to pay off that debt as soon as we can, start building our cash up. Because when you have a lot of cash in your balance sheet in the mining business, it gives you so much flexibility.
Leverage.
For instance, just so much flexibility. For instance, let's say you have 500 million in cash and your free cash flow is $1 billion. That $1 billion that comes in, every single penny, that's free cash flow. Yeah. That $1 billion in cash flow, every single penny of that can be given back to the shareholders. And they're still sitting at 500 million.
Yeah.
That's how it works for shareholders in a big way.
Instead of just paying off debt, right? You're giving it back to shareholders. Yeah.
You're just giving it all back to the shareholders, doing buybacks and dividends, and your multiple just keeps going up, 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 up. And nobody's doing it. It irritates me to no end.
Yeah. I got
Arlen, one final thing on that is that no CEO even talks about it. I go to Beaver Creek, there are no majors there, but Equinox is there. They're becoming a major. I had Coeur there last year. The only one, nobody talks about it. I bring it up on some of them because they have a lot of cash in their balance sheet and no debt. I'll bring it up and I'll say, are you cash focused? I was bringing it up. They won't bring it up to me. I bring it up to them. The only one that ever said yes was Westgold. And now they have some debt. So let's see how fast they pay it back. And Wayne, I forget Wayne's last name, the CEO of Westgold, but he told me, yes, that's my plan. I'm going to want to be cash focused, keep 100 million cash plus on my balance sheet. Any debt that I acquire, I'm going to pay it back as fast as I can. But most of these companies, they don't like that. They don't like that strategy because it literally makes you become shareholder focused. I don't think these companies want to be shareholder focused. I mean, I'll give you one last example is First Majestic Silver. At one point, First Majestic didn't have any debt and they had a lot of cash. And now they have a bunch of debt. And it's like, how did that happen? How did you lose that strategy? And it's basically, if you don't, and it just goes to show you it wasn't really their strategy to begin with. It just happened. So I hope, and I give them a bad time. I talked to them at Rick, and I basically said, what are you doing with all this debt? And they said, well, we don't have to pay it back until 2027, and the interest payment's low. That doesn't offset the benefits of not having it.
Yeah, very true.
I think they had a 1% interest rate. We have really low interest rates. Well, you still have to pay it back, and it's still on your books. It's still on your books, and so it creates downdraft on your share price. I'd much rather have a bunch of cash, but maybe First Majestic will go back to that strategy of cash focused. I hope some of these companies somebody needs to show the way. We need a new Kirkland Lake to show the way.
Yeah. I think, whether it's First Majestic or any other company, there's a lot of companies that might have that plan, but they don't stick to it.
Exactly.
Right? There's a new shiny object, right? Like, oh, there's a new shiny object over there. Let's go chase that, and let's go build our spreadsheets and think what this could all do. But they're deviating from the plan that they told the original shareholders what they're doing.
What the mistake? Right? Yeah, the mistake they make is they try to put mining in the same bucket as every other company in the world. You can't do that. You cannot treat a mining company the same way you would treat, a normal regular company.
Yeah.
I don't know. I'm trying to think of an example: Starbucks or Home Depot or Microsoft, a company that actually has customers and has competitors. Mm-hmm. Mining companies do not have customers; they have buyers. It's a big difference, and the buyers are all lined up. They get it. Mining companies get to choose who they sell to. They get to choose. It's like, okay, we have this guy, this guy, this guy. Who do we want to sell to? Mm-hmm. Buyers. And they don't have any competitors.
Yeah.
Barrick and Newmont do not compete against each other, except for if they're going to do a merger and acquisition. That's it.
I'll challenge you on one thing. They do compete for investor dollars.
I don't know how true that is, because they have hubris. As far as they're concerned, they don't really care about retail. So they're not competing for the retail dollar. Yeah, so the only thing they care about is institutional money. And there's plenty of institutional money to go around. So they're not really competing on that either. So the only thing that they're really competing on a management level is keeping their jobs. But because they get compared to each other. It's like, okay, Barrick's doing a better job than you. Newmont, they're doing a better job than you. So we're going to fire you because you're not doing as good a job. There's a little bit of competition there, but on the whole, Hecla and Coeur, they don't really compete against each other. Newmont and Barrick don't really compete against each other. All they really do is take gold out of the ground and try to get a good margin. And as long as they're getting a good margin, everything's fine. But they're competing against the price of gold and their margins. It really comes down to those two things. Can we get gold out of the ground and get a good margin? And then their buyers are there. We're gonna have plenty of buyers. We don't have to worry about that. We don't have any customers. So it's a different industry. You have to think of it differently. It's cash focus. It's cash required. It's all about cash. How much cash do I have? Because you're constantly investing money in your existing mines. It's called ongoing CapEx, sustaining CapEx. You got to constantly put money back into your mines, and then you have to constantly do exploration to find new mines. Constantly have to build new mines. So you always got to have cash. Whereas a company like Microsoft, they're not all they do, they just collect cash and put it in their bank account. Apple, put it in their bank account. A little bit of R&D, but it's not a cash focused business. It's a whole different animal, and they need to think this way, and they don't.
Yeah. I've only been in mining my whole entire life. But I can't think of like other things that could be more difficult than this sector because I haven't experienced them. But yeah, if you look at the risks out there, it's a tough industry. And then you throw the people that we deal with in there, right? Because it takes a certain type of person to be in this industry. we certainly put ourselves in a fun industry. That's all I'll
Yeah,
say.
I want to comment there about the difficulty. That is the reason why these companies need to be cash focused because
Yeah.
of the difficulty, because it gives them flexibility, because it lowers the risk of the company.
Hmm.
That's the reason why. I mean, if you're sitting on all that cash, what can possibly go wrong? I'll give you an example, Victoria Gold. Victoria Gold, they didn't have any cash. They went bankrupt, one little accident, and they didn't have any cash. Now, SSR Mining, they would be bankrupt today if they didn't have cash.
Hmm.
Wake up, people, wake up. You need the cash to defend against the unknowns. Um, that
What do
those two examples should just wake everybody up in this industry.
Okay, so I do got one last question here. We talk about cash. How do you feel about a gold company that's sitting on $100 million in cash, putting that in owning gold with that? Like you saw it in uranium companies recently, right? Like,
Oh,
oh, we're gonna go buy all this uranium, blah, 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 blah. What do you think of that?
absolutely. I absolutely love that idea. They should do 50-50. So
Who's doing is anybody
they
doing it
should
right
have
now?
50, they should have 50% in cash, 50% in bullion. The company that started doing that, it was Silvercrest, and now they got bought out by Coors, so that's gone. But Silvercrest was bought. They were actually the way that the tax situation works and the way the investing works is mainly investing, but what they had to do was they had to sell all their silver and report it as revenue, and then go and take their cash and buy back silver.
Wow.
They have to do that, otherwise the market penalizes them. How stupid is that?
Ugh.
And that's why businesses don't do it. But if that's how the market works, fine. So you're going to have to. So what First Majestic's going to have to do is buy back silver from the refiner. So they're
Yeah.
basically have to sell their silver to the refiner and then refine these bars and then buy the bars from the refiner and put it on their balance sheet. I think that's what they're going to do. And
Hmm.
that's what the companies should be doing is, yeah, okay, so you mine the gold, you get the revenue, you get the income, and then you go and you take that cash and you buy back gold and silver. I absolutely think it's a brilliant idea because why hold cash over long term if you can hold gold or silver? It makes no sense, especially silver. Silver's going to go up 3x, 4x, 5x, and dollars are going to be flatlined.
Well, that's where I bring this point up, right? Like if we're in gold and silver, we have to believe the theory that the US dollar is going to get crushed at some period. And
I think
if you're running a gold producer or a silver producer, you'd probably think the same thing. So do something about that, right? So
ironically, that might be a reason why they don't hold cash in their balance sheet. But if they did a 50-50 scenario like me, I think that works.
yeah,
You could even do more than 50-50 if you're not a fan. You just mentioned the dollar crashing, and I think that is exactly what's going to happen. I think we're going to wake up one day. I don't think it's going to happen in the next 2 years. I think we're going to wake up one day and there's going to be an announcement that basically they're going to do some type of a reset.
roll back.
I don't know exactly how it's going to unfold, but I do think that the outcome of that reset is the dollar is going to lose its value overnight. And I think it's going to be somewhere around 20 to 30%.
Wow.
And so you're literally going to lose. If you got $100,000 in cash in the bank, you're going to wake up and you're going to have 70 or 80,000. It's
Yeah,
just
that's gonna hurt.
it's
That's
just
gonna
going to
hurt.
go poof. It's going to go
Yeah.
poof overnight, and that's going to cause instant inflation. It's going to cause an instant loss of your standard of living. But they won't have a choice. It's the only way that they'll be able to deal with the debt problem.
Yeah.
And so, yeah, so the dollar is going to come under extreme pressure. Now, right now, the dollar's doing fantastic because, and I don't know how Trump's going to get it down right now, but Triffin's dilemma is kind of unfolding right now, where you know, this high dollar it kind of creates kind of a doom loop where if you any way that you try to reduce it actually makes it stronger.
Hmm. Hmm. There's no way
So
out. There's no way out right now, in my opinion. Like it just
I
my
agree.
uneducated opinion. I don't think there's a way out. Right. So
I
I think
agree. I think the doom loop has already started.
Yeah. Yeah.
And the only way that you really can get that dollar down is to kind of break the system. So we'll see what they do.
Cool. Don, that was awesome. Thank you. I asked for 20, 30 minutes from the guests, and when I get an hour, it's because it was an awesome conversation.
Awesome. Very
So
good.
that's incredible. Looking forward to meet you when you come up to Vancouver in May. Like
Yeah.
we'll
Yeah. See you
we'll
there.
grab a coffee or lunch. That'd be awesome. You're not going to be at the PDAC. But yeah, we'll meet you then, and really appreciate your time. I think some really valuable insights there. I love your model of the, something secure with some really good optionality. I think some gives a lot of upside for
One,
people in this market.
yeah. One thing, my book, the 10th edition of my book's on Amazon. So
Okay.
anybody's interested in gold and silver mining stocks, you want to read my book.
You'll get an
Yeah,
order today, buddy.
just go to Amazon, and just search for my name and look for my gold book. It'll be easy to find. It's got
Okay.
over 100 reviews on it.
Cool. We'll make sure that we put a link to on the page to the book for you there.
Awesome, Arlen.
Right on,
Enjoyed
Don.
it.
Thanks so much. Yeah, take care. Have a good day.
See you.